Hello everyone, welcome to the 216th episode of me learning how to trade in Forex. So in the last episode we went through Forex algorithmic trading, so understanding the basics. So activity in the Forex market affects real exchange rates and can influence the output, employment, inflation and capital flows of any particular nation. Computers can carry out user-defined algorithms characterized by a set of rules such as timing, price or quantity that determine trades. They went through four basic types of algorithmic trading. So statistical, which is an algorithmic strategy that looks for profitable trading opportunities based on the statistical analysis of historical time series data. Auto hedging, so a strategy which generates rules to reduce the trader exposure to risk. Algorithmic execution, so aims to execute a predefined objective. And direct market access, the optimal speeds and lower costs at which algorithmic traders can access and connect to multiple trading platforms. Also, a subcategory of algorithmic trading, which is high frequency trading, is characterized by the extremely high rate and speed of trade order executions. Triangular arbitrage is basically the process of converting one currency back to itself through multiple different currencies. And backtesting can be done using historical data. And then we started going through the Forex market definition, how it works, types, trading, and trading risks. So, understanding the Forex market, history of the Forex market, and the most traded currencies. Now we're on to the Forex currency pairs. So, in the global foreign exchange Forex market, currencies are traded in pairs, each consisting of two different currencies. In the chart above, you can see that the most traded currencies worldwide. So this one here, a currency pair is the exchange rate between two currencies, indicating how much of the quote currency is needed to buy one unit of the base currency. For example, in the Euro-USD pair, the Euro is a base currency and the USD is the quote currency. If the Euro-USD exchange rate is 1.2, it means that 1 Euro can be exchanged for 1.2 USD. Below is an example of how the Euro-USD pair has traded since the introduction of the Euro in 1999. So Euro-USD spot rate exchange since the Euro's debut. 1999, January 1st, 1.16, dropped down to 0.85, went up to 1.56, and it's been steadily, going down over the years. Recent developments in Forex. So the introduction of electronic trading platforms in the 1990s vastly changed the Forex market, making it more accessible, efficient and liquid. Regulatory milestones such as the European Monetary Union's creation and the Euro launch in 1999 reshaped the currency landscape. Economic crises like the 2008 global financial crisis, the 2010 European debt crisis and the early 2020s pandemic also profoundly impacted currency pairs, leading to increased volatility and shifts in the market. The most widely traded currency pairs are the majors, which include Euro-USD, USD-JPY, GBP-USD and USD-CAD. So these pairs account for a significant part of global forex transactions because of their currencies' economic and political importance. In recent years, emerging market currencies such as the CNY and the INR have gained more prominence as their economies have grown. Nevertheless, they haven't yet broken high onto the list of most traded currencies. JP Morgan Chase & Co., UBS Group AG and Deutsche Bank are some of the biggest banks involved in the global FX transactions. In addition, the rise of cryptocurrencies has introduced a new dimension to the Forex market, with some investors view them as alternatives to traditional flat currencies. That said, cryptocurrencies are a drop in currency flows compared to the tidal waves traded daily in flat currencies. The crypto news site, The Block, puts daily crypto trading between the extremes of 30 billion and almost 100 billion in the mid-2020s. Even on its most traded days, the value of all crypto traded less than 1% of daily Forex and far less on most others. So types of Forex markets, there are I think that's meant to say there. There are three key types of Forex markets: spot, forward, and futures. So spot Forex market. The spot market is the exchange of currency between buyers and sellers at the current exchange rates. This makes up much of daily currency trading. The major participants in the spot market include commercial, investment and central banks, as well as dealers, brokers and speculators. Large commercial investment banks make up a major part of spot trades, trading not only for themselves but also for their customers. Here are some features of the spot forex market. Accessibility, often a starting point for beginners in forex trading because of its relative simplicity. Decentralized, trades are conducted directly between parties without central exchange. Immediate settlement, transactions settled within one business day, abbreviated as T+1. Real-time rates, reflects current supply and demand dynamics. Isn't transaction settled in 2 business days, and only the USD to CAD trades are settled on 1? Forward forex market. In the forward markets, 2 parties agree to trade a currency for a set price and quantity at some future date. So, 3 key types of forex markets: spot, forwards and futures. Forex market. The exchange of currency between buyers and sellers at the current exchange rate. The exchange of currencies between buyers and sellers at the current exchange rate. The exchange of currency between buyers and sellers at the current exchange rate. Some features of the spot forex market: accessibility, decentralized, immediate settlement, real-time rates, reflects current supply and demand dynamics. Number 2, forward forex market. So forward forex market. In forward markets, 2 parties agree to trade a currency for a set price and quantity at some future date. The 2 parties can be companies, individuals, governments, or other entities. They are not traded on exchanges. 2 parties agree to trade a currency for a set price and quantity at some future date. 2 parties agree to trade a currency for a set price and quantity at some future date. 2 parties agree to trade a currency for a set price and quantity at some future date. The 2 parties can be companies, individuals, governments, or other entities. They're not traded on exchanges. Here are some features of the forward forex market. Hedging. Forwards are used to manage currency risk by locking in exchange rates for future transactions. Customization. Contracts can be tailored to specific needs regarding the amount, delivery date and other terms. This makes these contracts illiquid. So they're not very easy to flow, I guess. Private transactions, conducted over the counter, offering privacy and confidentiality. Counterparty risk. Participants must assess counterparty reliability to mitigate credit/counterparty risk. Futures forex market. Futures markets are like forward markets in their function. However, the big difference is that future markets use centralized exchanges, which guarantee traders against counterparty risk. Similar to forward forex market, but use centralized exchanges, which guarantee traders against counterparty risk. This helps ensure future markets are highly liquid, especially compared with forward markets. Here are some features of the Forex futures market. So exchange traded on organized exchanges like the Chicago Mercantile Exchange. Margin requirements. Participants must maintain margin accounts to cover potential losses. Transparency. Prices and trading volumes are publicly available, reducing counterparty risk. Options market. The options market allows traders to buy or sell currency options, which gives the holder the rights but not the obligation to exchange currency at a specific rate before a certain date. Options market, so gives the holder the rights but not the obligation to exchange currency at a specific rate before a certain date. Here are some features of the Forex options market. Hedging and speculation, used for both hedging and against adverse currency movements and for speculative purposes to profit from price moves. Premium costs. Buyers pay a premium for the option, which can be a cost consideration. The dramatic rise of Forex trading. FX market turnover by instrument, trillions. FX swaps, spot transactions, outright forwards, options, currency swaps, other. 2.5. Okay. The data does not include exchange traded FX such as FX futures and related options, though this is a small part of the overall market. Swap market. The currency swap market involves the exchange of two streams of cash flows in different currencies. Swaps are often used by banks or financial institutions to manage currency exposure and liquidity. Swap market, so the exchange of two streams of cash flows in different currencies. Swaps are often used by banks, financial institutions to manage currency exposure and liquidity. Double transactions involves a spot transaction followed by a forward trade. Involves the exchange of two streams of cash flows in different currencies. Liquidity management helps institutions manage their currency positions and liquidity. Customizable, terms can be tailored to the needs of the parties involved. Involves a spot transaction followed by a forward trade. So a spot trade and then a forward trade. A spot transaction followed by a forward trade. Forex market examples. Spot market example. Let's say the Euro USD exchange rate is 1.08, meaning it takes 1.08 USD to buy 1 euro. Now suppose you think the dollar would depreciate against the euro, so it's going to take more USD to exchange for 1 euro. The exchange now you suppose you think the dollar would depreciate against the euro and exchange 1,000 for euros at this rate, receiving almost 925.93 euros. Later the exchange rate changes to 1.1, meaning it now takes 1.1 USD to buy 1 euro. Your prediction confirmed. You decide to convert your euros back into dollars. You receive about 1,018.52. This means you've made a profit of $18.52. But suppose you were wrong and exchange rate decreases to 1.06, meaning it takes 1.6 USD to buy 1 euro. You would then receive 986.73 USD, resulting in a loss of 13.27 USD. Swap Forex example. Suppose we have two banks, Bank USA and Bank EU, in different countries with different currencies. Bank USA based in the US has a surplus of USD, while Bank EU based in Europe needs euros to fund loans to its American clients. So US bank has a surplus of USD, so has loads of USD, whilst Bank EU needs euros to fund loans to its American clients. It needs euros. Then to currency swap instead of going to the foreign exchange market to buy the currencies directly. Under the swap agreement, Bank USA agrees to give Bank EU a certain amount of USD, and in return Bank EU agrees to give Bank USA their present worth in euros. But doesn't Bank EU need euros? So why is Bank EU given euros? They set a date when they will swap the currencies back. Here's what they agree on. They set a date when they will swap the currencies back. Here's what they agree on. Notional principal. Both banks agree to exchange a principal amount of 100 million euros and its equivalent in USD at the present rate of 1.1 euro USD. So it takes 1.1 USD to get 1 euro. This means Bank EU receives 110 million USD from Bank USA, and Bank USA receives 100 million euros from Bank EU. Interest. They agree to exchange interest payments on the notional amounts. Bank EU will pay Bank USA a fixed interest rate of 3% annually on the USD notional amount, so 110 million USD. Meanwhile, Bank EU will pay Bank USA a floating interest rate of EUR interbank something interest rate plus 1% on the euro notional amount, so 100 million euros. Wait, what? They wrote this wrong. Bank EU will pay Bank USA a fixed interest rate of 3%. Meanwhile, Bank EU will pay Bank USA a floating interest rate of... Shouldn't USA pay EU Bank something as well? Why is there two Bank EU paying Bank USA? Maturity. The swap will have a maturity of 5 years. At that point, the banks will exchange the original principal amounts, 100 million euros and $110 million, having already paid interest during the swap for each other. The swap agreement helps banks manage their currency exposure and ensures they have the funds in the right currency for their operations. It also allows them to hedge against currency fluctuations, as the exchange rate for the swap is determined up front. Right. So types of Forex trading, reason for trading Forex, description, traders, hedging. Reducing or eliminating exposure to adverse currency changes. Most global companies use the Forex market for this purpose. Traders, corporations, financial institutions. Speculation, taking on risk in anticipation of future price movements. Speculators try to predict market trends and profit from short-term fluctuations in exchange rates, so individual traders and hedge funds. Arbitrage, exploiting often incremental price differences in different markets to make a profit. Traders buy a currency in one market and simultaneously sell it in another where it's priced higher. Banks, financial institutions, high-frequency traders. Interest rate differences. Taking advantage of interest rate differences between countries, traders may borrow in low interest rate currency and invest in high interest rate currency. Carry traders. Diversification, spreading risk by investing in different asset classes. Forex can diversify a portfolio, as currency moves are often uncorrelated with stocks and bonds. Can also geographically diversify a portfolio. Institutional investors, portfolio managers. So currency moves are often uncorrelated with stocks and bonds. Advantages and disadvantages of Forex trading. Forex markets have key advantages and disadvantages. Pros: lots of flexibility, trading 24 hours a week, 24 hours a day, 5 days a week. High liquidity, low transaction costs. Leverage for margin trading can lead to outsized gains. Cons: less regulation and decentralized nature of Forex markets increases counterparty risk. Leverage for margin trading can lead to outsized losses. Credit/counterparty risk of fraud. Advantages of Forex trading. Let's put together the benefit traders find in this area of finance. 24 hour markets. Okay, isn't that what they just wrote up here? Unlike other markets that operate during set hours, the Forex market is open 24 hours a day, 5 days a week. This allows traders to take advantage of market prospects anytime, providing greater flexibility for those with busy schedules or those in different time zones. Accessibility. Retail traders can start trading relatively small amounts of capital, and trading platforms provide tools and resources to help beginners learn and participate in the market. High liquidity. The Forex market is the most liquid financial market in the world. This high liquidity means that transactions can be executed quickly and with minimal price changes, which reduces the risk of price manipulation and enhances price stability. Leverage. Forex brokers often offer significant leverage, allowing traders to control large positions with relatively small capital. Whilst this can amplify profits, managing risk to avoid substantial losses is essential. Low transaction costs. Forex trading typically incurs low transaction costs, primarily in the form of spreads. This makes it cost efficient for traders, especially compared to other markets like equities or commodities. Disadvantages of Forex trading. Complexity. Forex trading requires a solid understanding of economic indicators, the effects of geopolitical events, and market psychologies. Forex market requires a solid understanding of economic indicators, the effect of geopolitical events, and market psychology. The learning curve can be steep, and you'll need to invest time and practice to develop effective trading strategies and risk management practices. Counterparty risk. When there's no central exchange guaranteeing your trade, there's always a risk of default by the other party, especially in fast-moving markets. I've seen this risk of default again. What does this mean? So, what was this? So, especially in fast-moving markets. High volatility. The Forex market is known for its quick swings that can take traders out of the game. Whilst this volatility can create prospects for profit, it also increases the risk for substantial losses, especially if you're inexperienced. Leverage risks. Although leverage can magnify profits, can also magnify losses. Limited regulation. The Forex market is decentralized and less regulated than other financial markets. While this can give you greater flexibility, it also increases the risk of fraud. Traders must exercise due diligence when choosing a reputable broker. In the US, that means using only one of the 6 registered and regulated FX exchanges. So, only use registered and regulated FX brokers. So, Charles Schwab Futures and Forex LLC, Gain Capital Group LLC, Forex.com, IG US LLC, so Interactive Brokers LLC, Oanda Corporation, Oanda FX Trade.com, Trading.com, Markets Inc., Trading.com. Market manipulation. Despite its liquidity, the Forex market is not immune to the machinations of large financial institutions and central banks. These entities can and have influenced exchange rates through significant trades or monetary policy decisions. Need for trading discipline. The fast-paced nature of Forex trading can lead to emotional stress and impulsive decisions that can amp up losses. Although the fact that it operates almost 24 hours a day can be a positive for some, it also means that some traders will have to use algorithms or trading programs to protect their investments whilst they're away. This adds to operational risk and can increase costs. To minimize these risks and costs, many recommend not holding positions into the next trading day. There's also the overnight holding cost, isn't there? So yeah, there's also that to think about. Can you get bling bling by trading Forex? Forex trading can make you bling bling, but it will likely require deep pockets to do so. That is, hedge funds often have the skills and available funds to make Forex trading highly profitable. However, for individuals and retail investors, Forex trading can be profitable, but is also very risky. How do I start trading Forex? To get started in Forex trading, first step is to learn about Forex trading. This includes developing a knowledge of the currency markets and specifics of Forex trading. It also takes a brokerage account set up for Forex trading. One of the more important things from here is setting up a trading strategy, which includes the amount of money you're willing to risk. How much do you need to start trading Forex? In most cases, you can open and trade via a Forex account for as little as 100 USD. Of course, the higher the amount you can invest, the greater the potential upside and downside. Many recommend investing at least 1,000 and even 5,000 to properly implement strategy, since otherwise fees and such will cut away any potential profits. The bottom line. Forex trading offers several advantages over other markets, such as flexibility with types of contracts and 24-hour-a-day trading for 5 days a week. It also allows investors to leverage their trades by 20 to 30 times, which can magnify gains. However, it also comes with substantial risks like high volatility, the potential for leverage-related losses, and the need for a deep understanding of Forex mechanics. Forex trading requires a disciplined approach, robust risk management strategies, and continuous education. Forex trading can be rewarding for those willing to invest the time and effort to navigate its complexities. That said, it's vital to approach it with caution and a well-informed strategy to mitigate the inherent risks. Cool, so that's that done. So you see these articles, they're like in different sections, but then some of them like are the same topic. So this one's in strategy and education section, how to start forex trading beginner's guide, but then in the trading section there's also how to trade forex. So it's like the same topic but in a different section for some reason. So alpha and beta, mastering short-term trading. Penny stock, Robin Hood, how to trade forex. So that's technical analysis. Guide to forex trading. View all guide to forex trading. Oh no, I think we opened that one. Okay, never mind. Go back then. So trading, guide to forex trading, and then strategy and education. And this is one of the articles in strategy and education. Okay, so what's this one? How to trade forex. Okay, that looks sensible. Forex market definition, so we just gone through that. Floating, what is it? Why is the forex market? How to use current forex course for beginners. Oh, hello, forex courses for beginners. Quantities of okay, so trading courses can require solid staying away from scams. Okay, this looks interesting. So you can get certificates for the forex courses you complete. Top 5 books for beginning forex traders. That'll be useful because remember in the beginning of all this I said that there's different information sources. I've got websites, videos, so we're going through the websites. I'll need to find some books for it and some videos, and yeah. So that'll be good. Forex course for beginners. Best method of analysis for forex trading. Forex spot rate, what is weak currencies, 6 questions about for currency trading. Rupee, understanding denomination, overshooting, currency pegging, direct quote, leverage, currency pairs, buy and hold, rollover, what are the most current forex trades, interbank, exchange rates, USD, how to calculate exchange rates, advantages, how to trade currency tomorrow, okay, currency, exchange, calculating profit and losses, Forex 3 session system, how to choose a broker, or how to trade Forex. So this is that one. How leverage, euro dollar, Forex markets, how it works definition, pros and cons. Okay, so I think one way we could go through, like, find all the useful bits is, because these are labeled within different sections, so for example, we've got trading, the main section, and then guide to Forex trading, a subsection of the trading section. Within that, there's the strategy and education section. So I think the way to, I guess, go through Investopedia page like efficiently is to find, as in, like, was it find, go to the smallest subsection as possible. So for example, is there another section within the Forex trading strategy and education section? Which I don't think there is, unlike here in the trading section, there's a guide to Forex trading section within it. So, oh, actually, here we go. So, in the guide to Forex trading, there's the strategy and education section, which is this bit. There's also the advanced concepts. So, whereas in here, I don't think there's any smaller sections within this one. So, this is the smallest section it can go. So, we'll pick up all the useful articles within this section, and then after we've done this section, we can move on to the advanced concepts, and then do the same thing as we did for the strategy and education section, which is find all the useful articles. And then so then we'll know that we've gone through all the useful stuff within the guide to Forex trading section, and then we can move up to trading section and then see if there's any other useful sections within this one that we can pick up more useful articles on. So start small and then work outwards into the bigger sections. Okay, cool. So guide to Forex trading, strategy and education, Forex courses for beginners. Is this one in here? Forex course for beginners. Oh, it's this one here. Okay. Right, let's get started with this one then. Forex courses for beginners. Investors looking to enter the world of foreign exchange can find themselves frustrated and quickly spiraling downwards, losing capital fast and optimism even faster. Investing in Forex, whether in futures, options or spot contracts, offers great opportunity, but is a vastly different atmosphere than the equities market. Even the most successful stock traders can fail miserably in Forex by treating the market similarly. Equity markets involve the transfer of ownership, while the currency market is run by pure speculation. But there are solutions to help investors get over the learning curve. Trading courses. Key takeaways. As an individual trader, it's never been easier to get access to Forex markets from several online and mobile providers. With easy access, beginners may find it in their best interest to read up on how the Forex market works and to hone their skills and knowledge with a Forex-specific trading course. Courses offered both online and in person. Keep a lookout for the course provider's reputation, feedback from past students, and if the course has professional accreditation or certification. So types of Forex trading courses. When it comes to Forex trading courses, there are two main categories. Two main categories of Forex trading courses. So we've got online courses and individual training. Online courses can be compared to distance learning in a college level class. An instructor provides PowerPoint presentations, ebooks, trading simulations, and so on. Student will move through the beginner, intermediate, and advanced levels that most online courses offer. For a trader with limited foreign exchange knowledge, a course like this can be invaluable. What's this? A course like this? Oh, hey, I already got this open. The fight. Wait. Is it the best? Yeah, it's the same. Okay, can be valuable. These courses range from $50 to well into hundreds of dollars. Individual training is much more specific, and it is advised that as trader have a basic Forex training before taking up this option. An assigned mentor, typically a successful trader, will go through strategies and risk management with the student, but will spend the bulk of the time teaching through placing actual trades. Individual training runs between $1,000 and $10,000 depending on the duration of the training. $1,000 and $10,000 depending on the duration of the training. Bulk of the time teaching through placing actual trades. Qualities of good Forex trading classes. No matter which type of trading a trader selects, there are several criteria to consider before signing up. So criteria to consider before signing up for Forex trading courses. The reputation of the course. A simple Google search shows over 1 million results for Forex trading courses. To narrow the search, focus on the courses that have solid reputations. There are many scams promising giant returns and instant profits. More on this later. Don't believe the hype. A solid training program won't promise anything but useful information and proven strategies. The reputation of a course is best gauged by talking with other traders and participating in online forums. The more information you can gather from people who have taken these courses, the more confident you can be that you will make the right choice. A solid training program won't promise anything but useful information and proven strategies. Certification for the course. Good trading courses are certified through a regulatory body or financial institution. So, certification for the course. Good trading courses are certified through a regulatory body or financial institution. In the US, the most popular regulatory boards that watch over Forex brokers and certify courses are the Securities and Exchange Commission, the Chicago Board of Trade, the Chicago Mercantile Exchange, the Financial Industry Regulatory Authority, the National Futures Association, the Futures Industry Association, and the Commodities Futures Trading Commission. Not all trading courses or system promoters are required to be members of the National Futures Association or registered with the CFTC, but most of the reputable ones are, and they adhere to those bodies' codes of ethics. For those thinking globally, be aware that each country has its own regulatory boards and international courses may be certified by different organizations. Time and cost. Training courses can require solid commitment if individual mentoring is involved, and can be as flexible as online podcast classes for internet-based learning, or can be as flexible as online podcast classes for internet-based learning. Before choosing a course, carefully examine the time and cost commitments as they can vary widely. Carefully examine the time and cost commitments as they vary widely. Carefully examine the time and cost commitments as they vary widely. If you don't have several $1,000s budgeted for one-on-one training, you are probably better off taking an online course. However, if you plan on quitting your job to trade full-time, it will be beneficial to seek professional advice, even at the higher costs. Staying away from scams. Make 400% returns in a day. Guaranteed profits. No way to lose. These and other catchphrases litter the internet, promising the perfect trading courses leading to success. Whilst these sites may be tempting, beginning day traders should steer clear, because absolute financial guarantees in the world of foreign exchange just don't exist. Unfortunately, the rise of online trading, electronic platforms, and open access marketplaces have fueled a parallel rise in scams. The Commodities Futures Trading Commission has long been concerned about dubious courses designed to prey on the unsuspecting. The CFTC has witnessed increasing numbers and growing complexity of financial investment opportunities in recent years, including a sharp rise in foreign currency trading scams. It warned in a release as far back as May 2008. To ensure where a trading course is honest, read its terms and conditions. The course's terms and conditions carefully. Determine whether it promises anything unreasonable. And determine if it promises anything unreasonable. And double check its credentials and certification for authenticity. Check its credentials and certification for authenticity. In particular, beware of sites that prominently display hypothetical returns or that show actual returns without the stipulation to the effect that past performance is no guarantee of future results. Or that show actual returns without the stipulation to the effect that past performance is no guarantee of future results. If you think you've been defrauded, contact the CFTC. The Commodity Futures Modernization Act of 2000 made clear that CFTC has jurisdiction and authority to investigate and take legal action to close down a wide assortment of unregulated firms offering or selling foreign currency futures and options contracts to the general public. Other types of Forex trading education. While trading courses offer a structured way of learning foreign exchange, they aren't the only option for a beginner trader. Those who are talented self-learners can take advantage of three options online, such as Those who are talented self-learners can take advantage of free options online, such as trading books, free articles, professional strategies, and fundamental and technical analysis. Again, even though the information is free, make sure it is from a credible source and has no bias in how or where you trade. This can be a difficult way to learn as good information is scattered, but for a trader starting out on a tight budget, it can be well worth the time invested. Can take advantage of free options online, such as trading books, free articles, professional strategies, and fundamental and technical analysis. Bottom line, before jumping in with the sharks, getting trading advice in the highly volatile Forex marketplace should be a top priority. Success in dealing with stocks and bonds does not necessarily breed success in currency. Forex classes and trading courses, either through individual mentoring or online learning, can provide a trader with all the tools for a profitable experience. I'm going to leave this episode here then. In the next video, gonna carry on with wherever the next one is, I think. One of these tabs. And yeah, so thank you for watching, and I shall see you all in the next video. Peace.